SoFi just posted $1.1 billion in revenue. They beat literally every single analyst estimate out there, and they grew their membership by a massive 35%. And yet, the stock dropped over 10% in a single day. Think about that. That is not normal. That is a massive, massive dislocation. Something is incredibly wrong here, or something is very right, and Wall Street is completely missing the boat. Stay with me, because by the end of this explainer, you're going to know exactly whether SoFi is the opportunity of a lifetime, or if they are hiding a serious systemic problem.
On paper, this company looks like an absolute unstoppable juggernaut. I mean, we are talking about record-breaking fundamentals across the board. They hit that massive $1.1 billion revenue mark, which is 41% year-over-year growth. Their ecosystem is completely ballooned to 14.7 million members. And get this, they just executed a staggering $12.2 billion in total loan originations. That's the highest in company history. They are out there executing flawlessly on this vision of becoming the ultimate digital bank.
But then we got to slam the brakes because the market reaction was absolutely violent. Despite all those stellar earnings, the stock plummeted 13.6% in a matter of hours. This is a stock that genuinely made people rich, rocketing from exactly $10.94 up to $32.73, and then it just broke their hearts. Right now, it's trading at around 18 bucks. It's down 30% year to date, sitting at a PE of 47x, and analyst targets are wildly all over the map, ranging from $15 to $30. It completely forces us to ask this central billion-dollar mystery. Is this a generational entry point, or are we staring straight at a falling knife?
Section 1. Survival on Trial.
To really understand what's happening, we have to look at this like a high-stakes courtroom drama. SoFi, this member-centric everything app for digital finance, is essentially on trial right now. Their very survival as a premium high-growth stock is being cross-examined by the market, and the stakes literally could not be higher. Let's start with the prosecution. The whole trigger for this massive wave of uncertainty was Muddy Waters Research dropping an absolute bombshell of a short report. They didn't just casually question SoFi's valuation. No, they attacked the structural integrity of the business, accusing them of using materially misleading inputs to artificially inflate their EBITDA, their core operating profit. They even went as far as to suggest SoFi is using Enron-esque off-balance sheet structures to disguise borrowings as revenue. In the financial world, those are fighting words. But the defense didn't just roll over and issue some weak PR statement. CEO Anthony Noto fired back with his wallet. He stepped right into the open market and dropped $500,000 of his own cash into a falling stock. Let that sink in for a second. When a CEO drops $500,000 of his own cash into a plummeting stock, that is a deafening signal of confidence. But it still leaves us asking, who is actually telling the truth here?
Section 2. The tech platform crash. To figure that out, we need to look at the internal damage, specifically looking at SoFi's vital technology platform segment. This is the infrastructure side. This is the part that analysts really hoped would make them the AWS of fintech. But man, that narrative took a massive hit. Revenue in this crucial segment basically crashed 27% down to exactly $75.1 million. And a huge chunk of that was losing a major legacy customer, Chime. Losing Chime hurt like a painfully expensive wake-up, and it left the whole tech segment absolutely reeling. Now the market is terrified that SoFi's back-end technology is losing its competitive moat.
Section 3. The technological arms race. See, SoFi has this incredible advantage of proprietary data from 14.7 million members for AI-driven underwriting, rather than just relying on, static FICO scores. But in this relentless battle for the future of finance, are they vulnerable to nimble AI-native fintechs building from scratch? It's a high-stakes technological arms race. Section 4. The bull defense.
Now, despite all these fears, there is a genuinely exciting bull case to be made here. The believers point to SoFi's financial services productivity loop, this system designed to cross-sell products with just ruthless efficiency. On top of that, they have an incredibly lucrative bank charter that gives them a massive 155 basis point deposit cost advantage with 65 to 70% deposit betas. They are 85 to 90% deposit funded, and they've maintained this absolutely relentless 18-quarter streak of crushing the rule of 40, which is that key tech metric balancing high growth and profitability. Plus, they're innovating. They just launched the SoFi USD stablecoin with a MasterCard partnership, and you've even got Mizuho analyst Dan Dolov publicly stepping up to defend SoFi, explicitly stating that the short report completely misunderstands or mischaracterizes key facts about how SoFi's loan sale structures actually work.
Section 5. The bear prosecution.
But look, we absolutely must give equal emotional weight to the bears here because they have genuine ammunition. You really need to feel the risk on this side. The bears are looking way past the top-line growth, and they're terrified that underneath this slick, glossy app there is a ticking time bomb of bad debt. SoFi reported a personal loan charge-off rate of 2.80%, but Muddy Waters claims that if you include delinquent loan sales, the true number is actually 6.1%. Now, management clarified that it's entirely manageable, but the seed of doubt is fully planted. It's exactly why we saw ominous downgrades from analysts like Wedbush's David Chiaverini, citing serious deteriorating capital concerns. And perhaps the most chilling part? Despite a blowout quarter, management flat-out refused to raise their full-year guidance. You gotta ask yourself, why hold back unless you see real trouble ahead, especially considering their internal models currently assume 0 Fed rate cuts?
Section 6. The jury is fractured. Because of these two wildly opposing realities, Wall Street and retail investors are just completely torn apart. It has sparked a literal war of sentiment on social media. You've got Noto's massive 500K insider buy acting as this huge beacon of hope, but it contrasts so sharply with broader insider selling and deep institutional skepticism. Just listen to the current consensus: 5 buys, 8 holds, and 3 sells. Nobody agrees. Literally nobody can reach a consensus on whether this company is the next big thing that's going to redefine banking forever, or if it's just a complete mirage destined to collapse under its own weight.
Section 7. The verdict. 4 triggers to watch. So how do we actually cut through all this noise? We need actionable intelligence. Moving forward, you have to relentlessly monitor these specific metrics to determine who is ultimately telling the truth. I'm going to give you 4 high-stakes if-then triggers. Trigger 1. Does the tech platform add 3 or more enterprise clients in Q2? If so, the bull signal flashes green. Trigger 2. Do charge-offs cross that terrifying 5% threshold? If they do, the bears are winning. Trigger 3. Is the rule of 40 maintained in Q2? If yes, management's credibility holds firm. And trigger 4. Do we get a surprise Fed rate cut? Because let me tell you, that would act as absolute rocket fuel for SoFi's margins.
Which leaves us with the ultimate, deeply polarizing question. Is SoFi a misunderstood tech giant about to completely dominate finance? Or are they just a capital-intensive bank masquerading as a disruptor? You've heard the evidence, you know the stakes. Now I want you to cast your verdict in the comments below. Thank you so much for joining me for this explainer. If you found this breakdown valuable, please hit that like button and subscribe so we can keep diving deep into the markets together.